Hi and welcome to our channel. If you decide to invest in the stock market, you need to understand what stock indices are. Why? By studying the dynamics of world indices, you can understand how certain events affect the quotations of companies representing various economic sectors. Exactly, stock indices help to understand the general tendency of movement of a certain segment market, avoiding the stage of complex evaluation of the position of a great number of uncoordinated companies. In turn, comparing indices with each other helps to figure out how different economic sectors trade in the market. If you are interested, watch our video till the very end to learn a lot of useful information.
Did you know? Over the past 20 years, the dividend yield of the S&P 500 index has averaged 2 to 2.5%. A stock market index tracks the ups and downs of a selected group of stocks or other assets. Watching the performance of a market index provides a quick way to see the state of the stock market, helps financial companies create index funds and exchange traded funds, and helps you evaluate the performance of your investments. A market index tracks the performance of a specific groups of stocks, bonds, or other investments. These investments are often grouped around a particular industry, such as technology stocks, or even the stock market as a whole, as in the case of the S&P 500, Dow Jones Industrial Average, or Nasdaq. When it comes to market indexes, there is no set size. The DJIA contains only 30 stocks, and the CRSP index contains over 3,700. The important thing is that each contains a large enough sample size to represent the overall behavior of the economic tape they seek to represent.
Each stock market index uses its formula in determining which companies or other investments to include. Indices that measure broad market performance may include only companies that rank high in terms of market capitalization or the total value of all their outstanding shares. Alternatively, they may be chosen by an expert committee or simply represent all stocks traded on a particular stock exchange.
Once the index manager has determined which companies to include, he needs to determine how those companies are represented in the index. This factor is called index weighting. Depending on the weighting, all companies included in the index may have the same impact on index performance or different impacts depending on market capitalization or stock price. The three most common index weighting models are market capitalization weighted. In a market capitalization weighted index, the index is more representative of stocks with higher market capitalizations. Because of this structure, large companies have a greater influence on the index's performance. Equal weighted. In an equally weighted index, all components are indexed equally. This means that each company's performance affects the index equally, whether they are incredibly large companies or incredibly small ones. Price weighted. The price weighted index gives each company a different weight depending on its current stock price. Companies with higher stock prices have more clout in these indexes, regardless of how big or small the companies are.
A stock market index acts as a barometer that shows the overall state of the market. They help investors determine the overall picture of the market. Investors take the stock market as a benchmark to decide which stocks to invest in.
Before you include stock in your portfolio, you must assess whether it is worth your money. By comparing it to the underlying index, you can easily judge the stock's performance. If a stock gives a higher return than the index, it is said to have outperformed the index. If it gives a lower return than an index, it is said to underperform the index. You will want to invest in a multi-bagger to justify the perceived risk. Otherwise, you may be better off investing in low-cost, professionally managed index funds. You can also compare the index to some stocks, such as the information technology sector. As an investor, you can easily recognize market trends. When you participate in stock markets, among other things, knowing investor sentiments becomes an important aspect. This is because sentiments affects the demand for a stock, which in turn affects the overall price. To invest in the right stocks, you must know the reason for their rising falling prices. At this point, indexes help you gauge investor sentiment. You can even find out investor sentiment about a particular sector and market capitalization.
There are thousands of indexes in the investing universe. One of the best-known indexes, the S&P 500, tracks the performance of the top 500 companies in the United States, as defined by the S&P Dow Jones Indices Committee. The S&P 500 is an index weighted by market capitalization.
The DJIA is relatively narrow in scope and tracks the performance of only 30 US companies selected by the S&P Dow Jones Index. Stocks within the DJIA come from a variety of industries, from healthcare to technology, but they are all united by the fact that they are blue-chip stocks. The DJIA is one of the few market indexes weighted the price. The Nasdaq 100 tracks the performance of the 100 largest and most actively traded stocks listed on the Nasdaq Stock Exchange. The companies on the Nasdaq may belong to a variety of industries, but they generally lean towards high-tech and do not include members of the financial sector. The Nasdaq 100 uses market capitalization weighting. The NYSE Composite Index is a composite index that tracks the performance of all stocks traded on the New York Stock Exchange. The index is a modified market capitalization weighting. While other stock market indexes focus on the largest companies in a particular segment, the Russell 2000 measures the performance of the 2,000 smallest publicly traded domestic companies. The Russell 2000 is an index weighted by market capitalization. The Wilshire 5000 total market tracks the performance of the entire US stock market. The index is weighted based on market capitalization.
Although the indices mentioned are generally used as proxies for the overall stock market, there are countless other indices, many of which are adapted to represent very specific market segments.
Environmental, social, and corporate indexes. Environmental, social, and management indexes focus on companies that are good at measuring how they treat the environment, their employees, their management, and society as a whole. Global indexes. As their name implies, global indexes track the aggregate performance of all companies in the world. National indexes. Just as the major stock market indexes mentioned above track the performance of the US market, some indexes follow the highs and lows of companies in almost every country. Growth indexes. Growth indexes track the performance of leading growth stocks or those stocks of companies that tend to grow faster than the market as a whole. Value indexes. Value indexes, on the other hand, aggregate companies are thought to be undervalued by investors because of their finances. Industry indexes. Industry indexes are created to track the performance of specific industries such as technology, finance, healthcare, consumer goods, and transportation.
Thank you a lot for watching this video. Stay tuned for more videos.